Right. So we've said it all year long. We have said rates vol is the primary driver of cross-asset volatility. And until rates vol subsides, equity markets look like they're going to be capped. So even though the Fed hiking cycle is being priced to be nearly finished, even as we've been seeing more hot data, they're still not pricing in loads more hikes, maybe one more hike. So I would have thought that would mean rates vol would come down a bit because the market kind of knows where rates are settling. Doesn't really seem to be the case. So if you look at TLT on this chart, TLT vol has spiked back to nearly as high as the SVB crisis level. And that's with us kind of knowing where rates are topping out. And the reasoning is, and TLT obviously is the long end of the curve, right? So short end rates were a lot higher in SVB because they were moving very dramatically. Short end rates, like 2-year isn't moving as much, but the 30-year is moving around like an animal right now. And that's because the curve steepening that we've seen in recent months. So we've seen a vicious curve steepening. We've seen a move in term premium. And what is term premium? That is kind of this fuzzy thing that you can't really put your finger on. But basically, it's the market requiring higher yields in the long end of the bond market because the market is questioning the credit worthiness of the US government and saying, if you guys are just going to keep issuing like crazy, we require a higher yield to take down your debt. And that is a move up in term premium in long dated yield. So we're starting to see that sort of stuff. And, that is going to have major implications for all asset pricing. So then if we look at the fact that real yields have also spiked. So what is real yield? It's the nominal yield minus the inflation. And so if inflation break-evens haven't moved and the market's expectation of inflation hasn't really moved because they think, inflation is kind of, sticky, but it's done going up. It's not going to go materially higher, but yields are flying higher. Then that means real yields go up. And the reason why people care so much about real yields is because this chart from Goldman's kind of shows you the relationship between real yields and forward PE multiples on the S&P. Because real yields are like an alternative to owning stocks. So if we look at Treasury real yields, that is kind of your risk-free return that you can earn on your capital, okay? Adjusted for inflation, right? Now, the alternative is put your money in stocks. And then the thing we look at for stocks is, well, what's the PE multiple on stocks? And generally, these two kind of should have some sort of relationship. So as real yields go higher, then the PE multiple on stocks tends to go down. Okay, and we haven't really seen that. We haven't seen that recently. We've seen a bit of a decoupling. So that suggests that stocks are quite expensive relative to what real yields are right now. And that means that there may be some wake-up call in stocks where they reprice viciously lower and PE multiples go from like 18 back down to like 15, 14, 15. And that would be quite a big shock in prices. Right, like we're talking about a 20% drop in prices in S&P, right? So, I mean, I'm not calling for it, but it is something we need to watch out for because people are now drawing parallels to 1987, and that was where rates were going up, and equities didn't care until they suddenly did care, and then we got the market crash of 87, okay? So I'm not calling for a crash, but we need to know the tail risks that are out there. We need to know the conditions that are out there, so that we don't just blindly go and sell downside risk with no protection in some stupid size that's going to blow us up, right? So that's what we need to avoid. And that's why we need to know about these things. And they should inform our decisions about how we go about taking risk. That's why I'm highlighting it. Not categorically not because I'm calling for an 87 style crash. Just to be very clear on that. Okay, now if we jump over to the S&P and look at the chart. So this is the S&P chart where we thought, a few weeks back, in late September, early October, we thought that the correction had probably played out, a correction that we had been anticipating. We got this A, B, C formation. It held at the lower end of the supports of the uptrend channel, the 200-day moving average. All these levels held, and it looked like we were starting the year-end rally back towards these sort of levels up at the top of the channel. Now, we are in this correction mode. Now, I wouldn't say the correction has necessarily done enough to say, okay, the rally's not on anymore. But if we were to give back this whole bounce and break below 4,200, which is 420 on SPY, that is your problem area. If that level breaks, then I don't see why we can't test 400. Okay. So whilst I'm not necessarily calling for that, we need to be aware of the potential scenarios in the market. And for me, that is a big one, right? If we can't hold 420, then that opens up a quick descent, because that is a massive support level, which if it's broken, we could see a bit of an air pocket down there. Okay, and the fact that all these puts have been bought and skew has gone bid means that dealers are going to be quite short risk down here, quite short gamma, and that can exacerbate the moves. So that is something we need to be acutely aware of. Okay, and if you haven't already de-risked or hedged for such a scenario, then you might want to be thinking about hedges. Okay, now if we look at the skew, you can see the way as we've traded down, the vol has kind of been trading up, and the skew is quite well priced. When I say the skew is quite well priced, what that means is the slope of that green line is pretty consistent with the slope of those green dots, which basically means the skew is expensive, but it's been justified. Okay, but the question is now, if we were to go down to 4,000, the vol's already priced above 20 down there. So are we going to see what we've often seen when the market breaks lower and vol struggles to perform, basically, and vol just kind of floats and stays, doesn't necessarily go up here? Hard one to call, but given that these levels of vol are already way above anything we've seen in the last 3 months, I'm not rushing to buy outright puts on the downside, basically, right? It looks like they're already quite expensive. So if you're looking for hedges, the skew looks expensive, the vol's more mid-range, what do? Well, you go for put spreads. Okay, that is your go-to hedge. That is something we cover in our portfolio hedging modules in our advanced options course. And this is something that I've taught to various asset managers on the street. And you know, it is, you kind of need to understand like what vol conditions are required for what types of hedges. Okay. So the strategy compass is pretty much bang in the middle, which is saying vol's mid-range and spots mid-range. Okay. So it's not clear that you should be putting on fresh put spreads right now. But the point being is, if you are aware of the scenarios that are in the market and you are quite exposed to equities, it probably makes sense to have some protection. And if you haven't already bought the protection when the market was higher, then you need to consider the type of protection that makes the most sense. Okay. And we can see here that carry's positive, which means that, you know, and the vol in the front end has popped quite a lot. So you don't want to just be buying outright vol and paying too much time decay. So put spreads take advantage of the elevated levels of skew. They don't buy you too much vega, so you don't mind the fact that vols are a bit more elevated, and they don't pay too much time decay. So carry being positive, again, these are all things that are going to push you towards put spreads, right? So buying puts as opposed to buying put spreads as opposed to buying puts. Okay. Now, what put spread would I trade? I'd keep it relatively short dated. I do think this kind of period of weakness is going to be resolved in the next month or so. We're going to either know that the market's going to have a wobble or it's not. That's kind of my impression. Obviously, the fact that OPEX is this Friday, when that rolls off, that is often a bit of a catalyst for some potential market weakness. If the fundamentals are kind of pushing it that way, then the weakness can come post-expiry. We often see that. Although we have started to see a bit of weakness yesterday, so maybe expiry can't hold us up anymore. It remains to be seen.